Alrighty, it is 11 o'clock, so we're going to go ahead and get started. Today we have Miss Patricia Williams here with New American Funding. She is going to be going over some creative lending options that you can share with your clients. It's a very, very helpful tool to be able, especially as you know, rates are what they are right now, they're not going down. So the more options we can offer our clients in order for them to be able to get their property sold and get under contract as buyers, that the more we can be a resource. So we are super thankful to have Patricia here to talk to us about this, and I'm going to pass it over to her right now. This is how you
Okay, 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 perfect. Good morning, everyone. This is Patricia once again with New American Funding. If I have not had the opportunity to speak or meet with any of you, just kind of give you a little background on myself. I am Patricia Williams with New American. I have been with New American for almost 6 years now, but I've been in the lending and mortgage industry, I would say about 25 years or so. So I've seen some things, and I know what these rates are doing now is it's not no surprise, or what I've seen here in this industry. Um, Again, New American, and just wanted to kind of go over some a few things with you all as it relates to some creative lending solutions. Our objective, obviously, is to get our client to the closing table, and we want to make sure that we have exhausted all avenues that we can to make sure that um, it is going to be benefit for them as it relates to the payment, the out-of-pocket expenses, the whole 9 yards. So I'm just going to go over some things, what I have here. And you can kind of see a partial of the flyer that I have listed here. And we're just going to get right into it. So the first one I'm going to talk about is lender funded buy down. So what a lender funded buy down is, and just kind of explain to you a little bit what a buy down is. A buy down is when the buyer is literally buying down their interest rate to get a lower payment, and most times you take advantage of that opportunity if you have someone that, let's just say, is a new buyer and they're trying to adjust themselves with the new house note. So you can actually, they can come in with a lower monthly payment. They're going to pay what we call points, and points is a certain percentage of the loan amount, to buy their interest rate down for a lower rate. And I'll give you an example. One I utilize most often is called a 2-1 buy down. And let's just say, for instance, that the market rate now is, for easy numbers, and this is probably about right, let's do it at 7% interest rate. So we'll start off 7% interest rate. So if they do a 2-1 buy down, that means that they're going to start out for the first 12 months with a 5% interest rate. 5% interest rate for the first 12 months of the loan. The next from the next 12 months will, then the rate will go up to a 6%. So it'll be 6% for the next 12 months. And for the third year, until the duration of the loan, the interest rate will be 7%. Now, one thing I do have to educate is to make sure it is not an adjustable rate per se. I mean, because you're actually knowing what the rate is going to. So it comes to us educating the client, the buyer, hey, you're going to go in at a lower payment, but over the next couple of years, it will adjust, and you will know what the adjustment will be and what the monthly payment will be. And again, you do have to qualify them on the higher payment. Although they're starting out at the 5%, they have to qualify for the 7% interest rate. So that is one thing. Now, also, because it's a lender funded buy down, just just know that it will cost a little bit more because it's lender funded buy down. And kind of give you an idea of the buy down cost. Typically, it's about Like for the 2-1 buy down that I spoke about, it's probably about, it will run about 2% of the loan amount. Now, the buy down cost can be financed into the loan amount. So just kind of keep that in mind as well. So the number two we're going to talk about a little bit is the Fannie Mae or My Community Mortgage. Um, the My Community Mortgage, some lenders have a different name to it. We have it listed as a Home Ready or Home Possible, and they may be the same. But basically, I utilize this particular program when I'm doing conventional financing because that's what Fannie and Freddie is. It's a conventional financing. And you, if they're a first-time home buyer or they have not had ownership interest in the last 3 years, they can take advantage of this particular program, and it's 3% down plus closing, unlike the traditional conventional loan, which is 5% down plus closing. So you can actually, let's just say you're out, they're shopping, they have a house that they're interested in, but let's say there's a seasoning requirement on FHA and they want to go conventional because the home was just put on the market or what have you. They can utilize the My Community Mortgage Program. And also, another thing with this, you can actually layer another down payment assistance on top of this one to help them cover that 3% down payment. So just keep that in mind when you're doing the Fannie Mae, the My Community programs, though, they are income driven programs, and some may be restricted based on zip code. So keep that in mind when you're dealing with these My Community conventional programs with the 3% down payment. There may be restrictions based on income and location. Okay. The next one I want to discuss is running multiple scenarios through AUS. Okay, as a lender, we have a couple of different platforms that we run our decisioning engine through the system to determine if the loan will come back approved or not approved. Typically, when I first get a loan, I only do it because I only do a soft pull on the credit. We can run the loan through what we call LP, which is loan prospect. We run the loan that route with just a soft credit pool, and sometimes we may or may not get an approval on the loan. If we do not get an approval and it does not meet the standard um, guidelines, then what we'll do, we'll reach out to the customer. Hey, I need to do a full pull on the credit. When I do a full pull, that gives me the option to then run the loan through what we call DU, is desktop underwriting. I know a lot of people are probably familiar with that term. It's desktop underwriting. This gives us the ability to run the loan a couple of different ways, a couple of different scenarios, so we can actually get the loan approved. Meaning, if it doesn't approve one way, most times we can run it through a different platform to get it approved as well. So just kind of know if I'm speaking with a customer or a client and I say, hey, I gotta pull your credit, then I'll pull the full pull on the credit, and then I can run it through a different platform. And most times I can get it approved that second way when we kind of do it through the desktop underwriting. Okay, number four, we're moving right along. I don't think I have any questions in the chat. So moving right along, adjusting the amortization period to lower the payments. So most of the clients that I deal with, I automatically put them on a 30-year term. Automatic because that way it lowers their monthly payment in order for them to qualify. Even if I have someone that is wanting to do a 15 or 25-year term, I suggest to them, hey, let's do the 30-year because the loans do not have any prepayment penalty. So if you choose to pay the loan off in 15 years, 25 years, that is perfectly fine. But what we can do is do it on a 30-year, which then, like I stated, it extends the term of the loan, lowers the payment, and then also it can give them the ability to have more buying power if they're looking or they're just wanting to look at a 15 or less a year term. So extending the term out to 30 years will give them more affordability and buying power. Okay. Number five, adjusting the interest rate. So, sorry about that. Okay, adjusting the interest rate. So, there is a way that we can actually adjust the interest rate to help with qualifying as well. So, let's just say if we have someone that is, right there on the cusp of getting the loan to work, we can always adjust the rate up, or we're trying to basically help with the closing costs or what have you. We can actually take the interest rate up to cover some of the cost. I don't think I have the flyer here, but I'm going to give you an example. So let's just say, for instance, if I'm working alone and a buyer is short some funds to close, what we can do, we can actually take the interest rate up to cover some of the costs. And what that will do is, here's an example. So if I have the rate on this particular one that I'm looking at, it shows here that the to get a 7.5 interest rate, I can actually give them a 7.5 interest rate, and that will cover right at $1,200 of their closing costs. So again, we're taking the rate up instead of it being what the rate is currently, the market rate is like 6.875. So instead of them getting a lower rate, I will give them a higher rate and cover some of the cost for them. Once again, as long as the ratios allow to take in, with the payment going up, we can actually do that to cover some of the buyer's costs. So basically, it's again taking the rate up to cover the cost. It will. Okay, the question is, will the rate ever go back down? No, sir. The rate will be locked in at that particular interest rate. So with that example, at that 7.5, it will stay at 7.5 unless they refinance or something like that. Okay. Okay. Number six, state, county, and local grant bond programs. So we at New American, we are licensed with any type of state, a city or county down payment assistance program. So that will help cover their down payment and or closing costs. Now, there are a couple of different programs. Some programs are the down payment is repayable and some is a grant. It solely depends on the program that they're going with. I know I'm going to give you an example state program through Mississippi and Tennessee. They have down payment programs. Some is a grant, some is repayable. And the repayable amount is basically they'll be making their mortgage payment as regular. But then if they get a program through the city or state that is repayable, that means they're paying back that down payment assistance. It's the program is giving them the money up front to cover those costs, but then they'll have to pay it back on a monthly. So they will have two separate payments. The ones with this Mississippi is a little different from the state of Tennessee. Tennessee, their repayable is like on a 30-year term, so their payment will not be very much. But then the one in Mississippi is based on a 15-year term. So, but and it's no prepayment penalty typically on those programs as well. So, if the client gets the money to have to cover that down payment or that repayable, they can pay it off and it's no penalty to do so. Um, Also, keep in mind some of these programs, these down payment assistance programs, they have restrictions based on location and income or household income. So we do have to make sure that they fit within that particular box. I, however, do have some programs in house that it does not matter what the income, and it does not matter what the location is. There's no restriction based on income or location. But a lot of these city and state programs, they do have those restrictions. In fact, I just actually closed a loan the other day utilizing a program called the Housing Fund. It's not new, but I'm just using it for the first time. And they have, it is repayable, but you can get up to $35,000 from the state. You're purchasing anywhere in the state of Tennessee. It will help and go toward their down payment and or closing costs. So it is array of programs out there available. You just have to check with your preferred lender to make sure that your client fits within those boxes. And most times on these down payment programs, like example and number two, the Fannie Mae product, you can actually tie two programs together. And again, you just have, it's ways you can be so creative. I'll throw another one at you. This Mississippi, they have a program that is just the interest rate. They'll give you a low interest rate. They will not assist you with any of the down payment or anything like that, but they'll just give you a low rate. Well, you can, and keep in mind, they have to be purchasing in Mississippi, but you can actually utilize the rate for that Mississippi Home Corp and then layer it with another program to cover the closing costs. So it's ways that you can actually be creative and make things work. So once again, just check with your preferred lender. Um, Now, number seven, mortgage credit. I don't do a lot of mortgage credits, but it is available because there is an upside and a downside to me for it. Now, the one time that you would use a mortgage credit, let's just say, for instance, you have a client and they're right there at the cusp of the debt to income ratio. So, give you an example, if they're at a 47% back ratio, and your ratio is the total debt ratio. Let's say they're at 47, where you can utilize this mortgage credit certificate and it actually gives them more income to possibly bring them in line so they can qualify for that particular program or product. Um, it is solely based on income. You have to provide their tax returns, things like that. So it's based on income and you can get up to $2,000 credit, mortgage credit. You actually get a certificate. But one of the things is that you have to know about this particular program is if you utilize that mortgage credit, there is a 9-year recapture tax with that. And that means that if your buyer sells their home within that 9-year period, not necessarily even if they sell it, but if they no longer choose that home as have that home as their primary residence, they have to pay a recapture tax. And what that means is if they, well, let's just say, for instance, they sell it. If they sell it, whatever the net proceeds that they receive, they'll have to give some of it back to the state. So that's the reason why I don't particularly use it, but it is available and it is there. If you have someone, once again, you'll use that product if you're right there at the cusp and you just need a little more income to get them over the ratio requirement. Okay. Let's talk about private lending. Private lending basically is other brokered out loans that lenders will use to maybe get a loan approved. So most of my brokered out loans are private lending loans. They have to do with my non-QM or non-qualified mortgages. Those for ones that has maybe a unique situation like a bank statement product or a 1099 product. They do not fall within the traditional route of a conforming product or an FHA product that we're accustomed to. And those loans basically sometimes depends on the product. They may take a little bit longer in as it relates to processing and closing because we're dealing with a separate entity. So if you're dealing with, New American, and it's a New American product, then that's different. But if you're dealing with private lending, um, you pretty much, you're probably extend another few days on your closing time because once again, you're at the leisure of the other at that broker. But once again, that's normally when you're dealing with a non-conforming or non-QM type products. Um, yes, sir. So, example, yes, that is some of the investors use that. Like if you're dealing a DSCR loan, something like that, then we'll actually reach out to one of our private lending institutions to actually go through there for them for the funding and things to that effect, like our DSCR loans, bank statement loans, 1099 loans, or no doc loans. So those all products fall outside of the traditional conforming guidelines. Mhm. Sometimes, most of them are geared based on your credit score. So most, when you're dealing with these non-QM loans, now it solely depends on the product that you're doing. Like a DSCR loan, I can go down to a 620, but some of the bank statement loans and the 1099 loans, you can go down to like 640, but yes, in that particular instance, your interest rate will be higher. But if you have a credit score around 680 or higher, then your rate is not just very high. And keep in mind, these type products, you do not have a prepayment penalty on them. Some of the DSCR does. But if you're doing like the bank statement, those type loans, most of them do not have a prepayment penalty. And let's just say you have someone that has a unique situation right now and they want to purchase now. But let's just say next year their taxes are right and everything is back on track. They can always refinance and then convert over to a traditional loan. Hmm. Yes, sir. Let's see, and I think that's it. But I just wanted to let you know there are so many different ways that a lender can be creative when working with your client. So for one, we just have to educate the bar and let them know what we're doing and what their situation is. Everyone's situation is unique and different. And I'm sure we have a particular solution for them all. And even if they do not fit within some of these boxes here, we can always create a plan for them so that they can circle back around. Okay. And that is all I have for now. Thank you. Okay. Okay. So I don't know if we have any questions on the chat. I don't see any questions. So again, I am Patricia Williams with New American. If you guys have any questions, my contact information is listed below. Um, Thank you so much.
Thank you so much, Patricia. Um, if you guys have any additional questions that you think of after this, please feel free to reach out to Patricia and ask her. If you have a client who you're not sure if they qualify for any of these programs, please reach out to see if there's something you can help make work for them. But we appreciate your time and we hope that you have a great day. Bye, everybody.